Good morning and welcome back to Almus Market Mornings. Inflation print from the US was quite subdued yesterday, rising in line with expectations. The headline CPI grew at 3.5% year on year, while the core grew at 2.5% year on year. Broadly, market reactions have been subdued to the print. Generally, the expectations has built that this would be enough to keep hawkish Fed members at bay, but we never know. There is still time for the next Fed meeting. Meanwhile, India's headline inflation rose to 4.45% as compared to the rise of 4.38% in the previous month. The rate, though, remains within the RBI's target band of 4 to 6%, but some have raised concerns about the prevailing food inflation. Good morning, JK. We had two inflation trends yesterday. How are you interpreting both? Because market reactions have broadly been very muted.
Good morning, Swaraj. Both India and US inflation numbers have given short-term comfort, but I'm sure they need watching in the days ahead. Also, muted market reaction is also because of kind of a thin market as Western world is now into a summer vacation. Yes, on the US side, they were almost as expected. No major changes, and two contributors are actually giving some comfort. One is the wage inflation, which is now quite lower, as you have seen in the average hourly earnings, which was reported along with the job numbers, on last Friday. And that is, of course, also corroborated with the unit labor cost data that was announced subsequently. And both indicate that there is no wage pressure. And that is actually a bigger contributor to the inflation. So that with that coming down, there is definitely some comfort. Oil prices have, of course, been holding below 90. And there's still some optimism that some sort of agreement on the Hormuz Strait will be reached, which can actually lead to oil prices staying lower levels. That is a hope rather than actual reality is somewhat quite uncertain. There is also some sort of a come down in the shelter inflation in US, which is down which is down 2.9% month on month. And that's a very comforting zone, because that is one of the largest contributor other than transport and also wage inflation. Now, the affordability of houses has been at the lowest level because of high prices and elevated mortgage rates, and consequently, the number of housing transactions are also on par with the 2008-12 post GFC environment. So, as more and more people are not buying houses, availability for rent is higher, and therefore the rents are also coming down. So there are some reasons to believe that US inflation is probably going to be under control, even with the oil prices at these levels. Of course, this needs to be on a more consistent basis. Overall, it does give some, comfort to the Fed probably to hold on in their September meeting, although they will have one more inflation report and one jobs report before they meet on September 16. FedWatch tool of CME shows now below 40% probability of a hike in September. It was 48% a day earlier. October is now showing a 58% probability. We'll also wait for the PPI inflation before we come to a certain conclusion. As I pointed out yesterday, the focus was also on the US budget deficit number for July, and that has soared to the highest level of on a monthly basis, more than 5 years, amid a surge in Medicare costs and also interest on federal debt. So it has risen to 432.3 billion in the month of July, up some 48% from the same month a year ago. Largest monthly deficit also, as I said, from March 2021. Tariff refunds have also contributed to it. The shocking thing is the annual interest expense on US federal debt, which is up to 1.38 trillion, and this is equivalent to 4.2% of US GDP, the highest percentage since 1997. So CPI may be lower and growth may be okay, but I think in the medium term, the deficit and the debt situation of US is going to uh, take more and more attention of market watchers and also the bond market, whose yields, of course, slightly stalled at the levels, but not really coming down. Any dips or any rise in the bond prices are getting sold, and the dips are very shallow. So definitely it needs watching. But overall, global markets had a limited reaction. Only reaction I can continue to see is in the yen, which is slowly and gradually pushing towards 160 mark. Crossing that would mean that another failure of intervention, though it was supported by the Fed as well. And eventually, if they are really serious about yen weakness to be contained, it is for the Bank of Japan to hike interest rate. And of course, the current indications are that they are not hurry to hike the interest rate. So it is going to be a very losing battle for Bank of Japan, at least for now. As far as Indian inflation was concerned, again, as you said, it came very much in line with the expectations, and 4.45%. So what contributed still to the higher number from 4.38% seen in June was the food inflation, which came at 5.52% from 5.32% that was seen earlier. The retail pass through to the retail in terms of petrol and diesel prices is also added to the inflation remaining higher as far as India is concerned. But it's all within the projection given by RBI. RBI had mentioned the expectation of 5% for FY27, citing softening global crude prices as well as supply side pressures easing. But the challenge for India is the global situation is far from certain. The moment it crosses 90, talking about the WTI. If it crosses 90, then all hell will break loose and will move towards 100. It is also in the context of the very low level of strategic petroleum reserves. So that risk is very high. And secondly, although we have had recovery in the monsoon in the month of July and also continuing into August, whether that actually helps the supply side on the food is something that we need to wait and see. So it is a wait and watch even for RBI, although in their next meeting, they are very unlikely to change the rates, and they should maintain the status quo. But data dependency is something that will not elude the RBI as well. So we are in a wait and watch mode in that situation also. As far as the global situation is concerned, there is no progress as far as the Iran-US talks are concerned. And Iran, I mean, one can say that currently Iran is calling the shots, and they are actually, controlling the way the discussions are going on, and particularly the Strait of Hormuz opening as well. Situation definitely remains fragile. Even with even a single Iranian attack on tanker capable of triggering another escalation, the world cannot withstand another big escalation in the war. That is something that we should be aware of. So possibly Iran is pressurizing US to come to their terms, because US is heading into a midterm elections, and the political compulsions would probably make them yield to some extent. So all this, of course, while all this is happening, INR has been a mute spectator, moving in around 10 paisa range. As I said, the balls have been dropping, and interest from exporters are less. Importers have been more active. But again, RBI is containing the volatility on both sides. Perhaps we need some new trigger for the rupee also to move. Even as optimism about the flows remain quite high. It's a quiet day in terms of market movements, but a lot of news to digest, and perhaps we will have the real reaction once the market comes back into full liquidity. Thank you.
Thank you, Jack. And yes, quite day yesterday with global and Indian markets also remaining relatively muted. We saw the US inflation print. It was well within the expectations. One sort of comforting factor was that the wage inflation was lower as seen on the update last Friday, as well as the unit labor cost data that was released subsequently. So it's a very important component, and that was well within the control. So I think that's where markets are getting some comfort from. Oil prices have been holding below $90 per barrel. Again, there is some sort of a hope that markets are holding that a deal might come through. And as Jacob mentioned, as of now, that seems like a hope rather than a reality. Shelter prices were down 2.9% month on month, which is again a significant weightage in the print. So overall, we are looking at a below 40% probability for a rate hike in September as per the Fed watch tool. Uh, but we have one more inflation and jobs number before the next Fed meeting. So that will be, it doesn't take time for things to shift in markets as what we have seen earlier as well. Indian inflation was broadly in line with expectations, and rupee broadly in a range of 10 to 15 paisa, both side volatility as of now being contained. That's it from us today. Thanks for listening. We will catch up tomorrow with a fresh round of updates.